All right, so this is pretty much our formula that we've had for the last year. U.S. Treasuries go up, 2-year goes up, rates go up, stocks go down. U.S. Treasury goes down, stocks go up, rates go down. So that formula is kind of, we're just stuck with that. The stock market's following the treasuries, it seems. I hate to talk about that every week, but it's so important to what you pay in the stock market, the interest rates. So I guess we got to keep talking about it. It's nothing we can do. So the news for today is that there's another inflation indicator that came in really hot. Let's look at the. Okay, so today that there was this. Let me see. Let me get the notes out here. There it is. The PCE, there were some inflation reports that came out this morning, and that's Federal Reserve's preferred inflation gauge, and it rose higher than expected. So all the Treasury rates rose, and stocks are going down. So it just, here's the headlines that I cut from them. It says, Fed policy rate seen higher for longer. That means that the stock market is not going to be going up. It's going to be going sideways to down for longer. Fed needs a recession to win inflation fight. So right now we're not in a recession. This PCE that came out today, it showed that consumer is spending, and that basically showed that we're not in a recession, and it's a strong economy. So. So it looks like the Fed is going to raise 50, more than the 25 basis points that they were supposed to. And there's three different Fed officials, non-voting, that were saying you have to raise 50 basis points at the next meeting. So there's the whole news on CNBC, et cetera, saying the inflation battle is just starting, and they're going to keep raising rates. So basically, the higher the rates go, the lower the PE ratios for the stocks will be, because you have competition. If you can get a safe yield from bonds that are almost 100% secure, why would you take any risk to get into stocks? So that's kind of the higher the interest rates, the harder it is for tech companies that are growing to borrow money.
So
say this every week.
Yeah, and with the new data, I don't think that you can really blame the Fed for not letting off the accelerator here on the rates.
Right.
Powell's been saying for a while that he's going to keep it higher longer. The last thing he wants is for it's like get behind the ball and like ease up, and then the inflation takes off again. That's what I think Volcker ran into a bit in the 70s, and he sees that and he doesn't want to make that mistake.
Right. So basically, we have to realize through all this, we have to adjust our expectations for stock market performance. We've been saying since the beginning of the year, it's kind of our whole predictions for at least the first half of the year have been like sideways to down, because until the Fed stops raising the interest rates, the stock market's not going to go up. So the Fed meeting dates are in blue here. So we already went through that one, March 22nd. That's the next month. And then we had to wait until May 3rd. So there's a very good possibility we'll have the 50 basis points there, and then you have to wait, and they might put another 25 there. So that's going to like put this whole half of the year to almost here. We're not going to go anywhere to go down.
But I think the good news here, if you're an investor, is if you can identify, the prices are all beaten down, but the economy fundamentally still seems strong in a lot of ways, right?
Mm-hmm.
And so I think that this is where, like stock picking, if you can find companies that have good foundational value and will do well as the economy does well. I think that there's a lot of potential for outperformance versus the index.
I agree with that. You have to be super choosy, and I think what's happening now with this evidence of inflation, the things that worked last year are pretty much going to work this year too, because we had this period of time in January where all the trash and all the stocks that went down the most last year went up the most in January and a little bit into February. But that was people were calling that the dash for trash, and there was short covering for the most part. So so it seems like there's a lot of people that are looking to something safer like yields, and I get a couple articles today on there's a huge inflow into yield-based investments. So companies that are safer, that pay a yield, and it'll get you by this area of at least 6 months to a year where we're going to be pretty much sideways and not doing anything. All right.
Yeah. Because I find it actually very difficult to be investing kind of in the 2021 environment where everything's kind of frothy, and you look at valuations, you're like, I don't see how this company is going to be worth what it's selling for, right?
Right.
You can ride that wave up, like in the index, but like trying to pick out stocks when everything is just kind of unmoored from the value that the cash it's going to produce and the profit it's going to return to shareholders. I find that a very difficult environment to be investing in. Where here, after things are down and prices are, you're like, oh, I can see how that would actually be worth what it's being sold for. I find that a lot easier to then start making picks.
Right. I think, but what's happened a couple times with the stocks we're following, some of the quality names we're following, we have to keep track of that PEG ratio of 1 and what is the true fair value of certain stocks. And, in a bad market, we had, in the COVID, time whenever everything was going down, and we had 2018, we had a big drop. We have to keep track of all the stocks that we're following in these big hedge funds and mutual funds and wait for them to get down to a fair value, because a lot of them are still trading for a premium. I'm going over one of those stocks today, like MasterCard. Right now, MasterCard's really expensive, but it's an example of a recession-proof stock. If there's high inflation, they sell less, but at a higher price tag. So, they're not doing as bad as other companies. So, so I highlighted that one as an example. We had Tesla a couple weeks ago. Went down to a fair value, a PEG ratio of 1.0. And now that we've been through a couple of those drops, we can see next time that happens that it could be a time to start looking into that. As a safe thing to invest in this kind of environment, because a lot of times you have the quality stocks, they trade for a premium, but when everything is on sale, they'll go down to like their growth rate in the PEG ratio of 1. Okay, so let me see.
And before we go, have we talked about, or have you on the agenda to talk about the stock buyback taxes?
The stock buyback taxes. That was supposed to start in January 1st, right?
Yeah, that's right. So there's a 1% excise tax on stock repurchased from companies.
I didn't hear it.
I think that's gone into effect.
I'm not sure. I didn't hear any news of that, any companies complaining, any news articles on that, since last November, when they started talking about that. I guess from that we're gonna assume that there's less financial engineering. Like IBM used to buy their stock back, and just to prop up their earnings, and I guess the amount of engineered earnings are going to go down. But I'm not sure if that affects the companies that much. We'll see. If I find an article on that, the effect of that law, I'll let you know.
So right now it's 1% as of January, and then I know that President Biden is pushing. He's talked about making it up to 4%. He wants to increase that over time. So I don't think that's going to pass anytime soon, but it is something worth keeping an eye on.
Oh, right, for sure. So some of the stocks we're following that buy back shares a lot are Apple, Microsoft. No, I think Microsoft. No. I know MasterCard was buying back. I have to go look back and look at our notes on those. But it's going to be harder for companies like Apple to engineer their numbers without that buyback. With the 1%. I don't know. If I find anything on that, I'll let you know.
Okay, thanks.
Let me see. Okay, so what are the things we're looking for in February? We had a holiday on Monday. It didn't really do any good. I guess the July 4th is a more visible holiday than Christmas and New Year's. But so we had President's Day, and market was closed that day. But we're still down for the week, and I think that has a lot to do with this inflation news. Okay, so we have end of quarter window dressing. Every quarter we have that to look forward to, companies. But in this environment, when they're raising rates, I don't think any of that works. I think that only works in a good when everything's going up. All right, so okay, we're done looking at this screen. S&P is down 3.5% or more since last week, and 10-year and 2-year are going up. They went up today, and they went up 1.3% until last night. So we've been saying this because of this Fed isn't done raising the interest rates. Seems like what worked last year is going to continue to work this year, and that's dividend-paying stocks that have low PEG ratios, safe business models, and they can raise their prices, and they have consistent demand in good times and bad. So we're going to keep looking for those. One of the stocks that is on my highest conviction list is MasterCard, and because they still do good in a recessionary environment. We're going to go over that, the fundamentals on that later on. Okay, so we just keep track of these catalysts to make the market go up. So the Treasury is going up. Treasuries are going up. They went up more than 2.5% now this week. NVIDIA had a good earnings report and a good forecast. The most important thing wasn't their earnings, but they had a rosy forecast, and they pointed to AI as a good part of their earnings predictions. There was an article today about China. I think they said this before, but they're calling for a Russia-Ukraine ceasefire. So Russia has a little bit of leverage with Russia because they're one of their biggest trading partners. So if they somehow, I don't know, broker some kind of ceasefire, that would be really good for the stock market. Very low chance, but it was in the news today. Let me see. The market is currently oversold. It's like as oversold as you can get. So that's a good indication that the stock market could be going up. And let me see.
So China just a days ago was accused of trying to sell weapons to Russia, or planning to sell weapons to Russia. So the announcement today from China is maybe just political playing. cover their trap.
It
So
could be.
they're not really calling for ceasefire. They are just trying to make a sentence to cover their discovering or selling weapons to Russia.
Yeah, I guess they're trying to distract from some of the things that they did wrong recently, and maybe that if something comes out of this, that I don't know. Yeah, they're probably distracting. They've said the same thing before, and nothing came of it. But if they're importing most of Russia's oil, and then they have a ultimatum, they say either you stop the war or we're going to stop buying things from you. That could have some leverage and cause kind of peace talks. But we've been waiting for those kind of catalysts and to really help the stock market and help the some of the stocks that we're watching. Let me see. Okay, so there's no more earnings. This is the end of earnings season. So there's nothing for the next month or so that's going to help the stock market, good or bad, for earnings announcements. So we just have a period of time we have to watch these reports from the government to see how the inflation is doing. Okay, so let's look at our information here. The oil is down 3%, and we don't want to speculate why it's going down, but the inflation it went up a little bit more today. So the inflation, there's PPI, CPI. They came out, that was decreasing month over month, but now the inflation report we had today is increasing. So confusing. We're not experts in this. We just want to invest in something. All right. The dollar is continuing its downtrend. It's basically at the top of this channel, but it's been going up for the last couple weeks. So we're still kind of in a lower highs, lower lows. Let's hope this keeps going down lower because that's better for multinational companies. Okay, let's look at our what's going up and down in the stock market. Let me see. Sector ETFs. Percent change. Retail ETF. Okay, why is that down? We had a very strong consumer today. I mean, it was a report that said that there was the consumer is continuing to buy, and it's a very strong economy. Why would that be bad for the retail? I thought that'd be good for retail. I don't know. Well, the reason why they set the technology company is going down. These are all high PE stocks. Not all. A lot of the XLK, the technology companies, are high PE ratios. The higher the interest rates go, the harder it is for them to fund growth. And when the interest rates go higher, people pay less for a multiple, which is the price to earnings ratio for stocks. And the higher PE ratio the stock is, the more it will go down in that environment. So, let me see. Real estate, biotech. See what's going up. Oil services. Okay, so look at, I guess oil is up a little bit today. Not a whole lot. You see. It's a good spot to find out a little bit. Okay, oil is up 1% today, and that's why you have all the oil stocks as the top performers. So oil and materials. Right, and financial stocks. Okay. Well, our theory from a long time ago was higher interest rates are better for the financials. But consumer staples. Okay, so we have a lot of stuff going down today. Let's look at some of the top performing U.S. market movers. All right. Okay, for the S&P, Lind PLC, they're a gas producer based out of, I think they're based out of England. Jim Cramer likes that stock a lot. I'm not sure, I don't know the news for that. I guess a lot of these are gas and resource-based companies like gas or oil, or one's going down the most. Let's look. I bet you all these are high PE stocks. Carnival. These are all the Jasper trash companies that went up a lot in
Can we look
January.
at ADSK? Because they had an amazing earnings, but only thing is I think their guidance was not great. But can we just take a look at it? Like,
let's look at ADSK.
And they are pretty decent company. They have been in a buy. Was it buys? Who raised it? Is Morningstar or Bank of America? One of them they raised it. So let's take a look at it.
So Autodesk, they make that 3D software where you can design.
They have the servers that render the movies and stuff. So
they do that too. Okay, I didn't know that.
Mm-hmm. Yeah, all the 3D movies or any what do you call not cartoon? What is called? Yeah, it's the specific word. The cartoon movies mostly they go through Autodesk.
Interesting. All right, so it's kind of a conservative stock. It's according to Yahoo Finance, its PEG ratio is very, very close to 1. It's maybe 20% overvalued, according to Yahoo Finance. Its PE is 29. Trailing PE is 76, but 29. That's pretty high. So let's see if it's actually growing at that rate. Autodesk, that's earnings. Okay. And look at that. It's going up in a straight line. So 23. Look at what it's growing at. It's supposed to be growing at 30%. 6.63 divided by 7.29. That's 10% between this year and next year. 7.29 divided by 8.48. 15%, 14% between the year after that. So it's grown like 12% in the next couple years. So you add all those up and divide. So 12%, it's grown at 12%, and its P is 29. It's almost a PEG ratio of 2.5. I'm not sure where Yahoo Finance got that. Maybe that's its recent quarter it's basing this number on. But it's like 2.5 times overvalued. But this return on equity is extra good. That means they have a cost for the money that they receive for investing. They have return on that investment. I think so. It doesn't cost them a whole lot to make a new version of their software. I guess their business model is they sell software. They sell a monthly subscription to their services, and it costs them kind of a low amount to keep upgrading that software and add new features. And they have programmers and they have salespeople. That's kind of their business model. So I guess that's why you have really good numbers for the profit margins. Let's say in a bad, why would they go down? Why would maybe the real estate market? If some of who are their customers? Some of it's maybe 20% is Hollywood, maybe 80% is probably developers that are making houses, and in an environment where you have a housing market that's not so great, maybe those people won't be renewing their license. I don't know. Hold on. ADSK. Let's look at the chart now. Okay, so you can see they dropped a lot. You can see they're super oversold now. They dropped. Let's look at the big picture. Okay. So we said it's growing. It's growing at 12%, right? Let's look at. It's growing at 12%, and their PE is 30. Let's do another calculation. They're growing at. Their PE is 30, and they're growing at 12%. That's 2.5 times overvalued. So if you take their price right now, 194 divided by 2.5, $77 is like a fair value for this company. Just based on that quick calculation. So 77. Let's go back and look at the Autodesk in the worst times. And when it crashed, it went down to, this is the pandemic, it went down to 141. And let's say, okay, this is 2018. We went down to 104. So it's down 12% today. I'm not sure based on what news, but for a stock,
the guidance was not for next quarter is but they beat all the numbers really strong. They had a strong earnings, strong revenue, everything, but they said the guidance for the next quarter may not be great.
But you know what? Every company is giving cautious guidance.
Exactly.
So this could be just a throw that away, throw that guidance.
And then I think Morningstar, or I don't remember, Bank of America, they just raised their, raised it to buy, I guess. And they are still a very good stock. Because I think I have been watching this for a long time. It's very, very stable. Even during the crash, it did not crash really bad. It was still within the limits.
Okay, so we know in when the COVID, let's say, I'm just thinking 80% of their customers are 3D architects. Architects that are making buildings and building things, whether it be like maybe manufacturer designing bottles or something like that, or these are they're at a mercy of that industry. So if you don't make as many houses, that could be a real good reason why they're not giving a good forecast there. They're not, the architects aren't making as many things. I don't know, but so is this the kind of business that you can buy and hold? Is there going to be a steady demand for this product? The great thing about this company, I guess, is that all these software companies are moving toward a model of residual income. So they're all charging $20 a month to use their per seat, of their software. So it used to be you upgrade to Autodesk 2000, and then you had that for a year until it broke, and then you had to upgrade to something else. And now they almost all of these have that residual income. So that's great, but I don't know. I think I haven't looked at their competition. I would think Adobe would come up with something that's a similar product eventually. How durable is this moat that they have? I'm not sure. I haven't really studied this. I think they have. I haven't heard that many 3D rendering related companies that sell this kind of product. Do you know the competition?
I think Adobe is their competition at one point, but mostly I think this is kind of a pretty solid company on its own. So
let's look at their competition where it says it should say competition here. Hold on.
There should be
folders. This is week. Autodesk gives a little description. Usually it gives competitors right next.
Yeah, they next to it, right? Go to the summary. Maybe on the summary you'll
Summary.
see it.
Let's look at the summary. Summary. Okay.
Yeah. Similar to ADSK, not that.
Okay. Well, don't see it. Company insights. Maybe I have to pay for that. Hold on. Forget that. Chart. Conversion space. Analysis.
Maybe analysis.
They might have put the revenue trends. Okay, we can do a quick Google search. Auto. That's easy enough. Why don't we think of that before? SketchUp, TurboCAD, PSC.
They are small companies, yeah.
Nah, not company. There's no competition. All right.
Yep.
So for us watching this, it seems like a quality company, but it's still trading at a premium, probably because they have the only real good thing out there for this part of the world. But in a really bad time, a really bad market, it's not going to sell at a PEG ratio of 2.5 anymore. It's going to go down to PEG ratio 1, so that's 75. So that's okay. It went down to 100, in this little crash there. So whenever it gets down to 75, that's the time I would look at this. It's not niche enough where I would buy and hold it for 10 years because this market, how reliable is this market? I don't know. I haven't looked at it enough. But I'd rather hold like a Microsoft that keeps buying companies and keeps getting into new industries. And all you have for this is just the people renewing their subscription every month for one product, basically, I think. So I don't know how durable this business model is, but we'll have to look at that. But right now, it's still really overvalued. About 2.5 times what it's growing at. So, but it could be because they have a really good product that no one else. They have a moat. I'm not sure about that. That was a good little excursion.
Most of the animated movies they go to them.
Okay.
Without Autodesk, I think it's pretty hard. And I think maybe Adobe, some of those. Most of the Autodesk is very good in rendering the movies and getting it all done because they're pretty powerful, computers that render the movie. So, yeah.
Right. So that was a good little excursion that we have. Okay. So let's look at the S&P. This is the S&P. I drew out we had over a year and a half long lower highs, lower lows, and we marked this spot right here when it started breaking out. And it seems like we're going into this little uptrend. We started going higher highs, higher lows. If they raise interest rates, we're not going to go up here. We're gonna go back down to here. So let's hope that we hold right here. We're at oversold in the stochastics. We're at the lowest you can get, and we're at the bottom of this little channel. So there's a very good chance we could hold here. But if the talking heads on TV, and everyone talk everyone into a dismal, depression, then we'll end up resuming this downtrend. We don't want that to happen, but let's be hopeful that we continue this higher highs, higher lows. We're right on the edge right now. All right, so it's we always review this every week. This is the fair value of the S&P is around 3,000, and we're like pretty much right here. I don't know. We it looks like this whole year it's going to be choppy, just not going up, not going down. We're going to go sideways, and sometimes the best investment in that environment is like dividend yielding stocks. All right. So the fear and greed for this week is still greed, believe it or not, even though we're down. It's worse. We've been going from greed, less greed, less greed. Next week we'll be at neutral, then we'll be fearful, and then extreme fearful. But you got to keep your emotions in check and be confident in what you own. But right now, if you look at let's look at our emotional. Okay, we're getting to the point where we're still greedy here, but soon we'll be going through a denial process of fear, and then that capitulation is when everything you have to have real conviction in what you own, and otherwise you get sold out of the market, and you don't want that to happen. So just keep your emotions in check. Let me see. Okay, fear and greed. The VIX is 21. We're still kind of a complacent level here, and no one's really panicking yet. But it is going up, and because as the stock market goes down, it usually goes up. And okay, so here's some interesting news. Apple, like 10 or 12 years ago, they started investing in this company that monitors blood glucose levels. Instead of pricking your finger, that they would monitor the light wavelengths coming from your skin. And there's an article that says their quest to bring that to market could be paying off, and it could be I've watched it pretty soon. So that would be something. If they charge $20 a month for every person using this, so they're very innovative, and they're always looking at new ways to have residual income. So they said it's years away, but there hasn't been a good track record of bringing a non-prick monitors to market. So, it's something to keep in the back of your mind that they might come out with this, and it could be, really helpful for the earnings. But it might not be for 5 or 10 years. Let me see. Okay, we already talked about this. So it doesn't look like inflation's going to be going away as fast as we wanted. We had the CPI and PPI decreasing, but this is the favorite preferred inflation gauge. So that means we're going to be not going up in the stock market for at least 6 months to a year. So that's the way it goes. Okay, so we were saying earlier about what's going to do good in this environment. A lot of investors are pushing towards dividend-paying stocks and dividend-paying funds. So this one trader says what happened in January is a junk rally. There was a bit of short covering, and now in February, everyone's realizing this whole year is going to be like a loss, or it's going to be like flat to down because of this interest rate. So, people are shifting towards dividend income. So, let's see. So, investors are seeking safe harbor income generating stocks. And the ones that do the best have done the best last year, like Procter & Gamble and all the drug stocks, and those are the ones that'll basically at least give you a dividend while you're waiting for all this to go through. We had another piece of bad news about Boeing. Their quality control is not up to par. This is another example of, you got to have confidence in your stock. And like a lot of times, you lose your confidence. Companies lose the premium that they have earned in the market if they start coming out with bad products. And so Boeing this is another example. This could turn into another nightmare where the stock goes down based on not being able to make planes again because they have a quality control issue. So this is becoming an example of a stock they have a duopoly, like we mentioned last week, but if they don't have the quality plane, they're going to buy the other companies. So I don't know. It's becoming less and less of a conviction. Every week we're watching these stories. So when we're looking at the confidence level that you have in Boeing to sell a certain number of planes every year, when you hear stories like this that come out every year at least, it reduces your confidence level, and so investors pay less of a premium for that company because of that. So I just thought it'd be interesting to read. So they had a problem with their fuselage, which is a pretty big part of their plane. I mean, it's pretty important. You don't want the fuselage to be bad. So just think of all those airline companies that are thinking about buying a Dreamliner. There could be a fuselage, and I might have to wait. Well, they're probably thinking I might have to wait 10 years to get this. Well, I'm not going to order. I'm going to order an Airbus. I'll get it in 5 years. So that could affect their orders.
I think they are pretty good in also handling the downside. So you know what, they have been going pretty solid from last few months. So hopefully they will be able to tackle this pretty good.
I don't think this is going to be a big deal.
Mm-hmm.
This is very similar how they handled the other one. It sold off a lot, and then they said, "Oh, it's only paperwork." It was only paperwork, and it went down because of that. We just forgot to file a piece of paperwork or something like that, and it's a little bit more than paperwork. But let's look at it's down. Okay, so it's around 200 now. Let's look at where it was in the pandemic. It went down to like $100 a share.
Or 25 something.
95. Yeah. So let's just look just for kicks. Let's look at what its growth rate is.
Yeah. 10 to 15%, I believe.
We're gonna do two things. We're gonna look at their statistics, the quick overview of Boeing here. Okay, PEG ratio is 6. Wow, that is like one of the largest PEG ratios I've seen. Okay, let's look at let's see what's growing at right now.
P is like 416. Wow.
416. That's just nuts. I mean, well, they've had erratic earnings. Let's look at the PE on this. You can see if it's still different. PA is unknown. EPS is negative. Okay, so we know that we have a pretty weird situation when we see all that. Okay, now look at all this. Oh man, this is like a nightmare. This is a very unreliable situation here. We have, of course, the pandemic where people stopped buying airplanes, and then you had the quality control problems. They couldn't make the airplane because it wasn't certified. It's all that. And now they're having that same problem again. Now is it going to go down in the red again? I don't know. It's just been unreliable.
Also, they have a lot of orders for the plane, so which is
they have a huge backlog.
Oh yeah, they have like a huge, because which is not taken into consideration from last 2 years. So once they have that backlog and they'll start clearing, they'll go into profit. Unless they.
Yeah, the problem is, will they be able to make those planes? And would it be 20 years that they deliver them? And there's customers that could cancel their order and go with another company in the meantime.
Wasn't it not recent, but a month ago, good news that they were allowed to sell to China again?
I'm not sure. I didn't see that news come out.
Yeah, I did.
Okay, that's really positive because, if China started buying, these kind of planes, then that would be like that would be like an olive leaf to America because China is doing us a favor, because there's all this tension between us and the countries. I'm not sure about that, but I have a hard time buying and holding this stock because of the inconsistencies. And we have every year we have another quality control problem. It's not that I know they have a backlog of 20 years worth of planes, but can they make them in quality and deliver them? That's the tough part. And now look at these numbers here. They're going up. That's like double. I can do that calculation real quick. From 23 to 25, that's like amazing. But then you start going up 40% and maybe 30% after that. But that's of if you can still make the planes. I don't know. This is getting sketchy. I'd say my confidence level is going down every time they have a new problem. You follow this. You follow this, Joe. What do you think about this?
They are big companies, no doubt, and they have a diversified portfolio of commercial versus defense products.
Correct.
So every time they go down, I just buy. So like every time they go down to 140, I just buy. And they go up to 190. And they do that sometimes, a couple of times.
Right.
They won't go anywhere. And they've been a very solid company so before that incident of airplane crash and stuff.
Yeah, they're having a tough time. This is like the time when they had some airplane crashes. They were recertifying, and oh boy, it just every company has warts. Every company has a problem. It's not, no company has perfect orders, perfect everything, but this one has just, for me, it's just like a little bit too much unknown. You don't know what's going to come. What quality control problem might come out tomorrow. All right, that was a good little excursion. You see. All right, so what I did was for this meeting, I did a stock screen. I went on Fidelity, and I just did a search for all these things we're looking for in a stock. Let's look at the formula that we're using. We're looking for return on equity, profit margin, market cap, larger companies, a forward PE of pretty low, and then a growth rate more than 10%. And I sorted them by the size of the company, because usually if a company is a little bigger, it's a little more consistent. So I looked at that, and I saw what I do when I look at these screens is I try to highlight companies that have, well, what I did was I sorted each of these columns, and then I highlighted the top 10 of each of these columns. Like return on equity, I highlighted the top 15, and then I resorted them based on market size. Yeah, so you can see little highlights of, and then you see, wow, this one right here has, all these great, things about it. Maybe that's something to start looking into. So what I did was I saw that this return on equity is like 153, wow, and forward EPS is 20, which is pretty good. And I said, well, let's look at that again. This is let's look at the MasterCard, and I think this is a good thing to look at before we have a huge market swoon, because my confidence in MasterCard continuing to offer a product that's going to have a consistent sales and meet their earnings, I think it's higher than most companies, because even in this inflation environment, if you raise the prices with inflation, they'll sell less of a volume, but it averages out because you sell more products at a lesser cost. It's equal to the same as less products at a higher cost. So that's the simple math that I have. But the theme for all these credit card companies, for me, is 80% of the world still uses cash for most of their transactions, and there's a slow transition to digitizing transactions around the world, and that's my theme. So we're looking for profitability of over 10, return on equity over 10, and total debt. we have to compare that to the market cap, make sure it's not that much. And we also like to look at the yield and see what it's yielding. So, and also when we look at the E-Trade, the earnings estimates, we like to have this straight line up. In Boeing, we saw that it was like all over the place. That was pretty inconsistent. We like to see a steady track record where year on year it's going up, like in a straight line. And a lot of times we like to see the stock price go down to here while this line is still going up. And those combinations are pretty good indications you're going to have a good buy and hold stock. So let's go back and look at this MasterCard that I pulled out again. Rats. Sorry about that. Okay, so I looked at MasterCard. You can see that they have that, that steady line up. If you go back a couple years, like 10 years, you'll see that same steady earnings power of the company. And their estimates for next year and a year after, it's only 2 years. A lot of times you have more than that, but they're growing at 15%. And that's the estimates. And their forward PE is 29. So that means their PEG ratio is 2. So they're selling at a premium. It's like double. Their fair value is half of what it's selling at now. And they're selling at this premium because of the quality of their earnings. They have consistency. You can see they missed their earnings just 1 quarter by a little bit. But for the most part, it's going in a straight line. But in a bad market, you can see that this is Bank of America's 5-year estimates of growth is 13%. So that kind of matches our 15%, earnings estimates as we divide these years, this by this, we'll get 15. So, and we have this. They have a monopoly with Visa for 80% of the transactions in the world. So those are all moats that are hard to beat. And let's look at some more things. Profit margin. We're usually looking for 10, and it's 44. And return on equity is 144. We're like something more than 10. And okay, so I'm going to look at the MasterCard chart, and we were saying 170. Wait, MasterCard. We were saying in our calculations here, 175 is its fair value. So if it was trading at a 175 a share, it would have a PE ratio of 15. And that is the growth rate. So when a PE matches its growth rate, then it's fairly valued. So let's look at it at the worst market. This is the COVID lows. And that maps out to about $200 a share. That's pretty darn close to that 175. Look at that right there. In 2018, we had this correction around Christmas. And it went down to its fair value of 174. So the reason why we're doing this little exercise here, we know MasterCard's a quality company. And we know that, we're kind of in a dicey market here that could easily, turn into like a sell-off at any time because people are on the edge about interest rates. But you got to keep in mind this fair value of these stocks, and that gives you a good floor whenever there's a huge sell-off, and that's a good time to look for long-term positions. And we had that happen with Tesla. Let's look at Tesla. A couple weeks ago, we didn't really recognize it at the time. TSLA. We said it was fair value at that time. Right here, it was $100 a share, $110 a share. So that's an example of. Let's look at Tesla. So right now, the point with all this is a lot of the things we're following are pretty frothy. They have peg ratios over 1 right now, and a lot of times whenever you have a lot of times when you have the a sell-off, you have all these quality companies that trade down to their fair value. So we see that. Let's see what was traded. When's this trading at? 3.97 divided by 5.47. 30%. 5.47 divided by 6.7. 20%. So 25%. So Tesla is growing around 25% for the next 2 years. And if we look at statistics, 25%, its PE ratio is 50. So its PEG ratio is 2 right now. So if you divide 195 by 2, then that's $100 price that we saw before last 2 months ago. So I'm just making the observation that everything we're following. Let's look at our investment chart.
Tesla is a very uncontrollable piece. So I'm kind of wondering whether we can predict the growth based on the current price.
Let's look at the. I remember the year 6.57 divided by 7.77. 15%. Okay, so we have 20%, 15%, then back to 12%. I think there's a lot of competition for this company right now. It's only growing at 15%. It's trading double. It's true value. It's fair value, and they're getting into different things like robots and they're going to be powering. Maybe they might be the next ExxonMobil. They've already signed something with the government where they're going to allow their recharging stations to be used by other companies or by other people, brands. So it's more of an innovative company. It's really hard for me to predict that, understand that. I'm better at understanding like a Procter & Gamble or Google or Microsoft that has an existing product. They're just expanding a little bit. This one is, I think Ashok would know this better than me. But I'm really not sure. This is too much competition, too sketchy. Yet a lot of their earnings are based on government rebates that might not happen in the future. So it's not as reliable as for me to buy and hold it 10 years. When I buy a stock, I like to buy and hold forever. And sometimes it's a little hard to quantify a stock that's a tech company that keeps changing and adding new products and has competition. I don't know. Okay, we're getting real close to the end of this. I have to make sure I said everything I was going to say. Okay, we're getting into March. March is one of the better months. March, April, May. I guess people feel better in the summertime, and we have earnings coming out every quarter. Once we already had earnings come out here. We're going to have earnings come out over here again, and then we're going to have in May, June. We're going to probably have peak interest rates, and then we're going to probably at the end of the year. We're going to be celebrating no more raising interest rates, but you got to keep these. I think August, September, they're always pretty bad. So keep that in mind while you're investing. But I think that's all I have for today. I went 1 minute over my talk, so I can't really talk anymore. All right, well, I hope everyone has a good weekend. And if you have any questions, let me know, and I'll research it some more.